In the ever-shifting landscape of global markets, a peculiar phenomenon has emerged this week, a sense of calm amidst the storm. The latest inflation data from the United States revealed that prices rose faster than analysts had anticipated or hoped for in February, a development that, at least on the margins, bolsters the case for keeping interest rates elevated for an extended period. At one point last year, the phrase "higher for longer" struck terror into the hearts of investors and portfolio managers alike, evoking a primal fear that threatened to upend even the most robust portfolios. Yet, this time around, the reaction has been markedly different. Government bonds wobbled only slightly, and both U.S. and global stocks held their ground, hovering around record highs with an air of resilience. This shift in market sentiment signals a profound change. Interest rates are gradually shedding their suffocating dominance over global markets, and stocks are climbing not because they are fueled by the speculative fumes of imminent and aggressive rate cuts, but because they are intrinsically worth it. We have entered a new era where the apparent need to keep interest rates high in an effort to suppress inflation, now running at 3.2% in the U.S., is a bullish signal for risky assets like stocks, rather than a reason to panic. This delicate dance in the markets has always been an unstable one. Sometimes, bad news about the economy is interpreted as good news for markets, as it suggests lower interest rates on the horizon. And sometimes, this relationship flips around again. Now, we find ourselves back in a phase where good news is once again being welcomed as good news. Well, sort of. One could argue that we have been in this era for quite some time, and that in the brutal years of 2022 and 2023, nervy stock investors, spooked by a recession that never materialized and still blindsided by the supply shocks of the COVID era, misread high rates as a threat, rather than a sign that the economy was humming along nicely. This year, by contrast, stocks have proven to be perfectly capable of sailing higher without the fuel of low rates. We've seen a breakdown in correlations since January, said Greg Peters, co-chief investment officer at PGIM Fixed Income. I always felt it to be a spurious correlation anyway. The equities folks were worried when rates were going higher without understanding why they were. Today, rates being higher is a byproduct of much stronger than expected growth. The market has smartened up. Life would be exceedingly dull, and markets would cease to function, if everyone agreed with each other. Naturally, the doom-mongers are still doing their thing. Complacency is dangerous, proclaimed Albert Edwards at Société Générale in a note this week. Now that almost every market guru has walked back their recession call, wouldn't it be just typical if the U.S. economy now slides into recession? Some economic data still looks fragile, and echoes with previous run-ups to market shocks are striking, he said. Record highs in stock markets have also buoyed the economic narrative, he added. Something does not look right. Something always looks skewed to permabears like Edwards, but he does have a point. One recent academic paper argued that animal spirits or bubbles in markets can themselves be responsible for as much as an additional 0.8 percentage points on U.S. inflation rates. Feedback loops like these can make it even harder to predict what's coming next. In addition, investors know that markets are treading a tightrope. Pictet Wealth Management has clearly been investing in thesauruses. It has labeled this the year of the funambulist. A resurgence in growth and inflation strong enough to restart rate rises is unlikely, though impactful enough to take seriously, while the chance of a recession in the U.S., also improbable, also obviously matters. Neil Sutherland, a fixed-income portfolio manager at Schroders in New York, is not in the recession camp, but he does suspect some of the gloss on the U.S. economy will start to fade soon. Risk assets could struggle, he said, and he's not referring only to stocks. Sutherland said any deviation from the idea that U.S. inflation will generally keep sinking while the economy holds up could be a negative scenario, particularly when you look at valuations and credit. The extra premium that corporate debt offers on top of super-safe government bonds is close to its slimmest on record, reflecting runaway demand for this asset class. Still, the market's mindset is shifting around higher rates. I'm surprised when investors are still so nervous about rates staying high, said Karen Ward, chief market strategist for Europe at JP Morgan Asset Management. Zero interest rates were a sign of the ill health of the economy. Rates were low because economies were really struggling. Good riddance. As this past week has proved, we now know for sure that for stocks to keep demolishing record highs, in nominal terms at least, and for corporate debt to remain so firmly in favor, clearly does not require the Fed to cut rates 6 times, as the market had been anticipating just a few weeks ago. It might not even hinge on the Fed cutting rates 3 times, the path it has outlined. That leaves fund managers able to cheer positive news as and when it lands. Stop worrying and learn to love higher rates. In this new economic reality, higher interest rates are no longer a harbinger of doom, but rather a sign of strength, a testament to the resilience of an economy that has weathered the storms of supply shocks and pandemic-induced disruptions. The market has smartened up, recognizing that elevated rates are a byproduct of stronger-than-expected growth, not a threat to be feared. While the permabears continue to sound the alarm, cautioning against complacency and warning of potential recessions or market shocks, there is a growing recognition that these concerns, while valid, should not overshadow the underlying strength of the economy and the markets. Academic studies have shed light on the intricate feedback loops between animal spirits, bubbles, and inflation rates, highlighting the complexity of predicting what lies ahead. However, this very complexity underscores the need to embrace a more nuanced perspective, one that acknowledges the potential risks while simultaneously recognizing the opportunities that arise from a robust and growing economy. Investors and fund managers alike are learning to navigate this tightrope, acknowledging the improbability of a resurgence in growth and inflation strong enough to restart rate rises, while also acknowledging the unlikely, but not insignificant, chance of a recession in the U.S. As Neil Sutherland of Schroders astutely observed, any deviation from the expectation of declining inflation and a resilient economy could be a negative scenario, particularly when you look at valuations in credit. The unprecedented demand for corporate debt, coupled with the slimmest of premiums over super-safe government bonds, underscores the need for vigilance and prudence. Yet, amidst this landscape of risks and opportunities, a new narrative is taking shape, one that embraces higher rates as a sign of economic vitality, rather than a harbinger of doom. Karen Ward of J.P. Morgan Asset Management eloquently captures this sentiment. Zero interest rates were a sign of the ill health of the economy. Rates were low because economies were really struggling. Good riddance. The markets have spoken, and the message is clear: for stocks to continue demolishing record highs, in nominal terms, at least, and for corporate debt to remain firmly in favor, the Fed need not cut rates 6 times, as previously anticipated. In fact, it might not even hinge on the Fed cutting rates 3 times, as outlined in its current path. This newfound perspective liberates fund managers, allowing them to cheer positive news as it lands, unencumbered by the fears that once paralyzed them. The mantra of the day is simple: stop worrying and learn to love higher rates. In this brave new world, where interest rates are no longer a suffocating force but a symbol of economic strength, investors are called upon to shed their preconceptions and embrace a more nuanced understanding of the intricate dance between markets, rates, and economic indicators. The road ahead is not without its twists and turns, but for those willing to navigate it with open minds and a willingness to adapt, the rewards could be profound. As we bid farewell to the era of zero interest rates and the false security they provided, we must embrace the challenges and opportunities that higher rates present, confident in the knowledge that a strong and resilient economy is the foundation upon which enduring prosperity is built.